Hello, I'm Lindsay Konzak, editor of Modern Distribution Management and MDM.com. Welcome to this month's episode of MDM's Executive Briefing. In this episode, Associate Editor Janelle Stilton-Holtmeyer talks with Sanjay Agarwal, Wholesale Distribution Practice Leader at Deloitte. Sanjay shares insights on a recent report released by Deloitte on why distributors need to be more strategic about driving enterprise value. He examines the importance of distinguishing value from price and why this remains a challenge for many distributors. In our 7 Minutes With segment, staff writer Scott Merrill talks with John Weborg, President and CEO of Stellar Industrial Supply. John discusses Stellar's specialist strategy across its 4 divisions and why being a part of industry groups is beneficial to business. He also offers advice for young people looking to distribution as a career. As always, if you have a topic you would like to see covered or if you would like to be featured in a future episode, please contact us at editor@mdm.com. Thanks and enjoy.
I'm Janelle Stilton-Holtmeyer, Associate Editor of Modern Distribution Management, and today I'm talking with Sanjay Agarwal, Wholesale Distribution Practice Leader at Deloitte. Deloitte recently released a report, Driving Enterprise Value in Wholesale Distribution, that found that focusing on operational excellence and cost performance is no longer a successful strategy in wholesale distribution. To succeed in today's market, distributors must be more strategic about driving enterprise value within their companies. And that's what I'll be talking with Sanjay today about. Welcome, Sanjay.
Thank you. Thanks for joining.
So, can you tell me a little bit about this research? Why was it undertaken? What did you expect to find?
Sure. We started this research about a year back to understand how value is created in wholesale distribution industry and what companies are doing to differentiate from competition. The ultimate goal was to understand the success formula so we can help our clients achieve best-in-class performance. We examined about 25 to 30 wholesale distribution companies where financial information was available in the public domain. And from a quantitative analysis standpoint, we examined the companies on 3 key metrics. The first one was gross margin, second one was inventory turns, and the third one was return on operating capital. As most people know, gross margin and inventory turns are key drivers of performance in this industry, and the return on operating capital is a pretty good proxy for shareholder value. We even tracked these metrics over a decade to understand how the performance gap was changing over time, and then we distilled the key capabilities that we believed were required to deliver superior performance. From an expectation standpoint, we did expect to find performance difference between the companies, and we did expect to identify some high-performing companies.
Were there any surprises in the results?
Sure, I would say there were at least a couple of surprises in the findings. The first one was that the dispersion in performance across companies was much larger than we anticipated. Now, some of this performance dispersion can be attributed to the different lines of trade. So, for example, in the case of industrials, they tend to have high gross margin compared to other lines of trade, even though at the expense of inventory turns. The food industry, on the other hand, typically has a very high inventory turn, but low margin, and the electrical sector tends to be stuck in the middle, with a low to medium gross margin and a low to medium inventory turns. Now, what we found was that even within a cluster, there was a significant dispersion driven by strategic choices some of the companies are making regarding their business model and operating model. So, for example, the top performers in the industrial line of trade, they have 2 times the gross margin and return on operating capital performance compared to the bottom performer. Now, the second surprise was that the gap in the performance between the top performers and others had become much bigger over time. So, for example, the top 3 performers on average had the gross margin increased by 400 basis points over the past 1 decade, and in doing so, they doubled their return on operating capital. In comparison, the rest of the pack was able to increase the gross margin by just over 100 basis points on average. So those are the couple of key surprises that we saw from the findings.
Very interesting. So in this report, you delve into the importance of competing on value rather than price. What does this mean in wholesale distribution?
What we find is that companies that have prioritized revenue quality over pure operations excellence, they have delivered breakthrough value. One of the ways they do this thing is by competing on value and not just on price. These top performers have focused on strategic actions that improve gross margins. For example, what products to sell, which markets to enter, including global expansion possibilities, what value-added service to provide, including things like vendor-managed inventory, how to provide a better customer experience by using technology that is now available. So these are some of the things that the high performers are doing. We examined the impact of these strategic actions for almost over a decade. And what we found is that there's a clear evidence that the high-performing companies, they have improved their gross margin significantly, as I said before, by 400 basis points over the past one decade. And in doing so, they have more than doubled their return on operating capital while maintaining their asset efficiency. This is key, that they have not been able to go down in performance from an asset efficiency standpoint. Now, on the other hand, others have focused more on cost and inventory turns improvement. And while the return on operating capital has also improved for these companies, it is much lower than the high-performing companies. What's also interesting to note is that the high-performing companies have been able to increase their revenue growth by 3 percentage points per year faster than everybody else in our study.
Not competing on price and not racing to the bottom because of price are definitely not new concepts in distribution. Why does this need to be repeated so often, and why is this such a challenging idea in this industry?
Sure, that's a good question. When we look at distribution, it's a high complexity, yet it's a simple business model. Distributors buy and sell stuff, and many of them often think in terms of cost plus rather than the value that they deliver to the customer. So it can be challenging to think of valuing non-price factors such as having a broad product portfolio, providing a one-stop shop to the customers, the ease of doing business, and providing a better customer experience, to name a few. And it really takes a lot of thinking in terms of how do you price these non-price factors in pricing to the customer and increasing the margins that they can get from the customer.
More specifically, what can distributors do to improve enterprise value?
There's a balance between gross margin and inventory and distribution. Our research shows that distributors that have the highest return on capital, they have the lowest inventory turns. But these distributors are able to command a very high gross margin that resulted in high return on operating capital despite having low inventory turns. So within a line of trade, what distributors should focus on is gross margin expansion by addressing levers such as customer pricing, supplier cost, and supplier rebates, but without sacrificing on operational excellence. That's the key to improving shareholder value.
Is there a difference in how large distributors should approach it versus small distributors, or does this apply to all sizes?
The study that we did, we looked at 25 or so wholesale distribution companies, and that was across the board in terms of size. All of these are over $1 billion in general, 1 to 10 plus $1 billion. So our view is that this research and the findings apply to all of the distributors, at least in the $1 plus $1 billion range.
So what are some of the key ideas that distributors should really take away from this research?
High performers have made some strategic choices regarding their business and operating model that gives them higher margin and has helped them in expanding these margins over time and increasing the gap with the rest of the companies. We believe that distributors should develop best-in-class capabilities in 3 different areas. First is category management. Here the focus is on improving the end-to-end margins in the category by addressing sourcing, merchandising, and pricing. Some of the dimensions included here are product line expansion, private label penetration, supplier rebates optimization, and customer pricing optimization to expand margins. The second area is sales force effectiveness. This industry has one of the highest number of salespeople, but they tend to be more order takers. And what we find is that top performing companies have higher sales productivity, and they do it by focusing on having the right sales force structure, the right compensation structure, and by providing the salespeople with the right tools and training. The third area that we find is operations effectiveness. The high performers, they focus on revenue quality, but they do it without sacrificing on operations excellence. This includes a focus on distribution network optimization, G&A shared services, and even outsourcing of some select functions and activities. Now, in addition to these three areas, what we find is that leveraging technology to enable all of these areas I talked about is key. And distributors can use technology to achieve a competitive advantage, and technology can include both ERP as well as some of the edge applications like e-commerce or mobility, pricing, or supply chain tools like transportation management systems and warehouse management systems, just to name a few. So these are the things that distributors can use as key takeaway messages.
Well, I know technology budgets over the last few years have been really tight for a lot of distributors. Where do you suggest people start their investments?
Technology is big. The industry has been somewhat behind in adopting technology, and they're beginning to see the value in technology. ERP is definitely one place to start, but in addition to ERP, some other things, e-commerce is one of them, and mobility is another one. In terms of prioritizing, you really need to understand, how you can compete in the marketplace and where you can have the biggest impact. Things like ERP have typically they take a long time. It's a 2 to 3 year investment. And while you're doing ERP, you may want to also focus on some of the what I would call as the quick hits or low-hanging opportunities. Pricing is one of them. We definitely believe can have a significant impact on distributors. Pricing has now become a science, and given the high complexity in this industry, that can be used as an opportunity to get quick value, and in fact so much value that you can then use to reinvest in other technology applications like ERP.
So if our listeners want to learn more about Deloitte's wholesale distribution practice, where can they find more information?
Where we have a website you can go to. You can download all of the white papers that we have in this space. There are names of our experts on the website that you can reach out to. You're more than welcome to reach out to me, and I'll be happy to connect you with other experts in the firm. We are active in many of the distribution conferences that we present at. So, reach out to anybody you see on the website or just reach out to me.
Great. Well, thank you so much for your time today.
Sure. Thank you very much. I appreciate the opportunity.
And now for 7 Minutes With, which will feature a short interview each month with the leader of a distribution or manufacturing company.
Hello, I'm Scott Merrill, staff writer for Modern Distribution Management and MDM.com. Today I'm talking with John Weborg, president of Stellar Industrial Supply, an industrial distributor based in Tacoma, Washington. The company serves a broad range of customers through its 4 specialized divisions. Welcome to the program, John.
Thank you, Scott. I'm glad to be here.
So, how's business going for Stellar?
Business is going very well. We're up 31% year to date. We did an acquisition last year at mid-year, and about half of that growth is from the acquisition, but the other half is just our organic growth. We're seeing uptick in business. We just finished off a month that was a near record for us. So we're quite pleased with the environment and how we're executing right now.
And how's the outlook for the rest of 2014?
It looks strong. We're onboarding large new customers. Our budget was to be up 14%, so we're tracking well ahead of that. And it seems to me that the markets are firming up where we're serving anyway. Metalworking's firming up. Aerospace, there's a lot going on there, and so we feel really good about 2014.
Stellar focuses on being specialists across your different divisions. Why did the company decide to approach the market this way?
The division started for us because our customers were asking us to address other product categories. They're all trying to consolidate their vendor base, or most of them are. So we started in the safety arena, customers saying, you're doing a good job for us in your MRO, and what can you do for us in safety? Having said that, the specialist part of it, when you get into more technical type products, customers want to know that you're there for them and can provide them not only advice and consultation, but ideas, that you're roaming the countryside looking for new products that might support them and help them either mitigate risk or improve profit. So with our divisions, we have our own resources that we can bring to bear to the market. We certainly work with lots of supplier partners that can bring resources as well. But we just found that having our own resources, technically trained, driving customer profit and return on capital, we can make a case for a great win-win partnership with it.
Are there specific areas where you're seeing more strength? Are there any areas you plan to focus on more heavily in the year ahead?
Well, yeah, we have a very diversified customer base geographically as well as from a vertical standpoint. Certainly aerospace vertical, it's not a secret. There's a lot going on there and coming. We're certainly spending our time focusing on settling out our most recent acquisition. That's in Southern California. There's a lot going on there, and our overall business firming up. The marine business that we've engaged with over the years is firming up, and there's opportunities developing there. So generally looks strong to us. We're generally quite optimistic, but those pockets are definitely hotbeds of activity as we look through the rest of 2014.
What are the benefits of being active in industry groups, such as the Industrial Supply Association or affiliated distributors? Why should other distributors get involved?
Well, ISA as an industry association provides us an avenue not only to network and gain contacts throughout the industry with suppliers and fellow distributors alike and individuals, but it also provides us educational opportunities. We take developing staff to ISA so they can get a broader exposure, broader context about our industry, about the landscape and what's going on out there in the bigger world. And there's a lot of market data you can get from ISA. Educational programs and networking are all what ISA is about as an association. So AD is a buying and marketing group. It's a little different, but we go to AD meetings and we engage in best practice sessions with like but non-competing distributors, always hugely valuable. The AD provides financial benefit to our company through their programs with suppliers and also our ability to network. So I would recommend that any distributor in our industry get involved in the industry association, and if they can find a buying group, if they qualify to be an AD, they should certainly take a look at that and research it and work with AD staff to see if they can get on board. I've been involved in all the above quite deeply for a number of years, and it's definitely helped our business. Both ISA and AD have been huge benefits for our development of our business.
And then what advice would you give to a young person who's just getting started in the wholesale distribution industry?
Well, I would tell them to try to get with a great organization and ask for the opportunity to work in different areas and aspects of the distribution business that they join, so they can really understand, starting with customer experience, to really understand how that's delivered, really learn what it is that distributors are selling, what their differentiated value proposition is. To get involved in the industry association, there's a group in ISA called Young Executives Forum, and it's a great group, and there's some just phenomenal networking opportunities there.
What keeps you awake at night, or what things should managers and executives be keeping front of mind right now?
Well, as regards to the business right now, what keeps me awake at night, if I am awake at night, is seeing to it that we crisply execute and address the myriad of opportunities before us. We've got a lot of capacity at our company and management talent and staff talent, and we just have a ton of opportunities. So we need to be thoughtful about how we time and phase those and crisp in our execution. We need to make sure that we're working at speed, but with quality. So that's probably just directly for our business. That's always a thing I'm mindful about. For the broader economy, I'm concerned. The political environment is corrosive, and the regulatory environment is onerous. And I'm concerned just for general business. The economy generally is soft by almost any measure. It's not robust. I think that it won't be robust. So that's going to be something that we all have to make our way in that kind of an environment. And then for the industry specifically, there's a tipping point coming, I think. There's all kinds of opportunity, huge opportunity for people that are clear about who they are and what they are and what the customers and prospects that qualify to engage with them might be. there's an awful lot of folks out there that are pure transactional, and they're not going to be allowed to continue to perpetuate their business on that model if they can't really get clear about their value proposition. It's not going to be like it was, and the pace of business is faster. Things are getting ever more dynamic, and folks have to have some kind of compelling proposition or they're going to have some difficulties. So that's a concern for the industry, but it's also a great opportunity for those of us in the industry that will prepare themselves to avail themselves of that opportunity.
Great. Well, thank you so much for your time today, John.
Thank you, Scott. Enjoyed the discussion.